Sandip, hi, good morning. What's the word on the index itself first? The jobs data was taken positively or rather brushed away because, attributing it to weak weather, etc. But how are you approaching the global space?
Morning. I think what's happened, if we monitor the funds flow situation, the emerging market funds have lost $18 billion since the beginning of this year, which is more than the entire $15 billion they lost in the entire 2013. We've had 15 straight weeks of outflows, which is a record. The last record was set in 2002, where emerging market funds had 14 weeks of outflow. So this is a typical contrarian indicator of a bottom formation in the markets. So at least for the emerging market space, it seems that the worst could be getting over. So I think from the global perspective, that's how I see the, because fund flow, typical people panic at the end. And that's why we saw around $6 billion outflow of emerging markets last week itself. So just because of funds flow, the market recovery could be slow, because if money is moving out, it's difficult for the markets to move up fast. But
so
overall,
Sandip, day after day, even in the Indian markets, we are seeing sell numbers. They're very small, but now it is like of the past 15 days, maybe 10 or 12 days have been sell numbers. You would say this is lagged reaction and this will stop soon?
Yeah, because if ETFs lose money, they have no option but to sell in the markets, and that's what is happening. So if emerging market funds have lost $18 billion in the last, since 1st Jan, which is more than what they lost in the entire 2013, the full year, then they have no option but to sell. But I think that's not an indicator that people should be getting negative. I think that's more an indicator that the panic could be peaking out. And that also got reflected in the way the VIX index, the volatility index peaked out in the US markets last week, where it reached the top of the bull market range, and from there it corrected. So all these are key indicators which one follows, and which indicates, I think, worst could be over for the global equity markets.
Okay, that's good to hear.
You are sounding cautiously optimistic. You thought that probably the emerging markets are bottoming out, so is the Indian market. Should you start dipping into cyclicals?
I think cyclical, specifically, I think banks, because this week, is very strong on data. We have the IIP, WPI, CPI, although WPI is losing its relevance now. But I think at least on the CPI also, I think we'll see a significant dip, given the way the food prices have corrected, and given the way we actually see consumer deflation in the markets now. So last 2 years, we saw that companies were passing on price hikes, irrespective of what was happening around in the economy. But now there's an actual dip in consumption. And the savings rate also, which came out for last year, it's dipped to 30%. I think 30% is a very low savings rate for India, where we peaked, I think, above 36-37%. So I think that also reflects that people don't have that kind of money to spend now. So I think we'll see consumer growth now come back as the economy recovers. And to that extent, we could actually see consumer prices dip faster than what RBI projected in its latest policy.
Okay. I want to get a quick comment from you on sterling holidays. You used to track that closely, and there has been a 870 crore merger between Thomas Cook and Sterling. Would you buy Sterling now?
Yeah, I think it's a very positive move, because Sterling had got financial investors earlier, and actually you need someone to help you with the business. So I think what this does is that it gets money into the business when the economy is lagging and people are actually not buying so many of timeshares, because who will buy a couple of lakhs worth of timeshare when you are
and
as
the
it is
company is
stressed.
going under?
No, not when the company, when as it is you are stressed in terms of your finances, like with high consumer inflation and discretionary spending as it is down. So I think what this will do is this will help the company ride through this slightly rough period. Next 6 months.
Sandip, Sterling clearly suffered because a lot of people who bought those timeshares found the hotels unlivable 7 years later. So will that perception change with this?
No, actually that perception had started changing in the last 3 years, because the ex-CEO of Mahindra Holidays had gone and joined Sterling, and they had actually refurbished their resorts, and some of the resorts actually became very good. So that change had already started. But that during that period, they got hit with this entire slowdown of the economy.
All right, the market.
I mean, Sterling, the pre-opening rates are indicating that it's going to be a thumbs up. Would you buy this as a value stock?
So I think investors have to buy it over a period of time.
Oh, I think it's getting demerged. Sorry, it will get merged into Thomas Cook. So really,
no, but I think whatever I read, there's no proposal to actually delist, because I think they're going to buy it out from them. They'll have an open offer. So I think it will be a good buy for long-term investors. However, near term, I don't see that the stock is actually going to run up very sharply because the business is slow at this point of time. But as the economy recovers, we'll see these stocks come back.
Okay. Punjloyd is in the news. Actually, it was up close to 12% last week as well. It's up another 2% today. Some stake sale on the cards, but you know, with these stocks, you never know what eventually happens. Would you buy Punjloyd or stay away?
Actually, that's one stock I've been watching, especially after the ex-CEO of Reliance Power was appointed. But I think the biggest issue with Punjloyd always was that it was not the business which they got. It was how they used to execute. And I think with a strong CEO at the helm, we could see some value emerging, because finally if we see the stock trades at around maybe 5% of its peak value even today. And if the business can be managed properly, there's obviously value in a stock which does business which is slightly higher end.
Have you also been watching Aban? I mean, it's just up and away, and numbers were good.
That's a company which is very difficult to predict, and one is not sure about the management of that company also. So to that extent, I wouldn't buy that stock ever.
Okay, well actually I would.
Sandeep, DLF is the top gainer in pre-opening, up 3.5%. Will you buy it at 142?
I think given the kind of debt reduction which we are likely to see in DLF, because 2,200-300 crores is a significant amount relative to the total net debt of that company. So this could be one indication for a turnaround in sentiments on the stock. And finally, the stocks actually corrected quite significantly from its top. I think it's down around 40% from its peak, which we saw a few months back. So we could see a decent uptick, but I think it will be more a trading buy rather than a buy for the long term, because the real estate sector still is under a lot of stress.
Okay. Well, Sandeep, you know, we left off the conversation on financials because the markets opened. Just complete your state-owned bank's argument. State Bank hasn't come out with numbers. PNB and Baroda actually indicated at least asset quality may be stabilizing. What is your pick?
So I think Valentine's Day is when SBI reports. So maybe that could be a Valentine for state-owned banks, and state-owned banks could bottom out on that day. Because I think this CPI, WPI, everything also will get over by then. And I think you would be, I guess you are tracking it much more than me. I believe the government borrowing for this year is over.
Yes.
And the spectrum sale expectations have gone up. So I think the expectation of the money that government will get from that has gone up. And a couple of other disinvestments are also on the line, HZL and all, if it gets through. So government finances actually could be looking much better. So to that extent, if there is some expectation building up that bond yields could actually trend down to 8.6% by 31st March, and that should also be positive for banks. So overall, my guess is that banks should do well going forward.